Module 5, Interest Rate Risk Management. So when it comes to interest rate, we discussed this previously. So nominal interest and real rate. We calculated through Fisher equation, but essentially real interest rate is the nominal interest rate minus that by inflation rate. So nominal encompasses real plus inflation. And when it comes to the tax implication, if you want to calculate real interest rate after tax, then you will want nominal interest rate times 1 minus company's tax rate minus inflation rate. Because since interest can be claimed as tax deduction, interest rate forward curve is an implied yield curve of interest rates applicable at future points in time. As I mentioned when we were going through the overall subtopics and everything, that there are a lot of risk management frameworks that go through within the subtopics, and in here there are key steps in interest rate risk management. So first is set the core criteria. Secondly, identify exposures. So in order to identify exposures, there are 3 main steps that we can follow. First, calculate the raw exposure. Secondly, determine the primary immunization, offsets and adjustment clause. And then look at goal setting and examine secondary adjustments. Before we appraise risk and set strategies, we can look at managing time mismatches. For example, for cash flow management, there is something called credit sweep. This is an arrangement between bank and a customer whereby all idle or excess funds in a deposit accounts are used to pay down short-term debt under a line of credit. So automatically sweeping the sub-accounts of subsidiaries into a central account at head office. This will improve cash management. We talked about factoring before. This is when you sell off your accounts receivable. There's also another thing called forfeiting for debtors. This is a contract whereby defaulting party to give up their ownership of an asset as compensation for the resulting loss to other parties in order to manage timing mismatches. There's also another thing called gapping analysis. This is to identify when the prices of interest rate sensitive assets and liabilities are renegotiated. So gap is calculated by assets minus liabilities, and positive gap is value of interest rate sensitive asset is higher than the value of interest rate sensitive liabilities, whereas negative gap is the liabilities are higher than the assets. So for normal yield curve, interest rates for short-term maturities are lower than long-term maturities, whereas inverse yield curve is when the short-term maturities interests are higher than the long-term maturity interest. So risk management through offsets. For primary offsets, this is industry-based offsets. There are commercial offsets, embedded options such as ceiling floor price arrangements. For ceiling or floor price arrangements, this only accepts a pre-specified range of interest rate movements. For CPI adjustments, price or costs are adjusted for inflation. On costing, that is when you pass on charges in the cost of producing products. So these are transferring risks. There's foreign currency offsets, which allocates expected foreign currency cash flows to time buckets. Commodity offsets, which you can input the risk into products or adjustment by way of semi-finished goods. Price adjustment clauses, this enables transfer its exposure to interest rate movements to other party. And there's another thing called diversification or portfolio. So that was the primary offset, and for secondary offset, that is more financial market-based kind of offset. This includes financial restructuring. So step 3 of appraising risk and setting strategy. There are 2 necessary decisions that boards need to make: risk-return trade-off and goals of the dealing unit if Treasury is to operate its dealing unit as a profit center. So this entails who's gonna be the profit center, what is the role of the Treasury operation. So the board needs to decide on that. In order to identify benchmarks, there are 3 elements that can be looked at. So return on assets, that is the possible target for the company boards. So ROA is net income divided by total assets. Product margins, that is commonly used by the operating units. bonus pools or retrenchment triggers for stock-oriented negotiations or operations. In order to determine the fixed or floating ratio, we need to look at the financial strength of the organization, competitors, hedging policies, and the board's risk appetite. So the factors that has potential effect of short-term interest rate movements are financial covenant with lender, financial ratio monitored by rating agencies, potential to meet or miss budget objectives, and WACC calculations. In order to calculate the forward rate, there's a formula for this. For example, if we are looking at forward rate of t equal 4 and t equal 5, then 1 plus r5 to the power of 5 divided by 1 plus r4 to the power of 4 minus 1. Let's have an overview of interest rate risk management instruments. Let's look at the scenarios. So if you want to remain fully floating, then what instrument would you use? Nothing. If you want to reduce exposure of fixed and floating mix, then you would want to use swaps, and no premium will be payable on swap. If you want to remove uncertainty of fixed cost, then you would want to use swap. If you want to protect target profit level, then you might want to use options, and this has option premium payable. If you want to protect against crisis, then you would want an option or out of the money option. If you want to protect downside but at a zero premium outlay, then you would want a zero cost collar, and there's no premium payable if it's structured at zero cost. And lastly, if you want tailor-made alternatives, then you would want a knockout option. So here are some examples of any instruments that you can use based on the strategy. We're gonna have a look at an example of converting floating interest rate exposure to fixed rate exposure. So firstly, retire the outstanding floating rate bonds and issue new fixed coupon bonds. This will be costly due to transaction costs, advisory fees, and compliance costs. For interest rate swap, this would eliminate uncertainty about future borrowing rates, and it ensures that a single fixed borrowing rate applies for each period. When it comes to transforming floating interest rate exposure to fixed interest rate using a swap, floating rate bonds would be minusing BBSW, bank bill swap rate. When it comes to swap payoff, so for the fixed rate payer, it would be BBSW minus swap rate. So the hedge position in this case would be floating rate bonds plus swap payoff, which would be minus BBSW plus BBSW minus swap rate, which equals to minus swap rate. We're gonna have a look at different types of interest rate. Interest rate cap is a call option where the underlying instrument is a floating interest rate. So it has the advantage of locking in a known cost of insuring against rising cost. If rates do rise, then credit spread may also increase and effective cost will rise. A cap rate is a strike or exercise interest rate on the cap. When it comes to effective borrowing rate, if the BBSW or if the floating rate is greater than cap rate, then we will use cap rate. Since the floating rate is higher than what you have kept for, you can buy it at a discounted price, so you're in the money. When it comes to gross borrowing proceeds, the formula for this is present value equals principal, divide that by bracket 1 plus R times N divided by 365. That's really random, but I just put it there. For interest rate floors, this is a put option where the underlying instrument is a floating interest rate. So when it comes to effective borrowing rate, if the BBSW is less than floor rate, then you will exercise the option. If the floor rate is higher than the BBSW, then that's good because that means you're gonna sell it at higher price. That's when you're in the money. When it comes to interest rate collar, that is when the payoff long collar equals to the payoff long cap minus payoff long floor. When it's a zero cost collar, then the premium will be zero. You're trying to give a boundary between one cap and one floor so that you're within this threshold. When it comes to interest rate swaptions, that is an option to enter into a certain interest rate swap at a certain time in the future. So swaption rate will be a fixed rate, and if the market swap rate at maturity is higher than the swap rate on the swaption, then you would exercise the swaption and enter into the swap. Whereas if your swap rate right now is less than the swap rate on the swaption, then you will let the option lapse. That is for the payer swaption, but then when it comes to the receiver swaption, it's the opposite. So if the swaption rate is higher than swap rate, then you would go with swaption rate. You would receive the fixed swaption rate and you would pay floating rate. So that was step 4 for appraisal. Step 5 would be accounting and controls. This relates to IFRS 9 financial instruments. All derivatives must be recorded on the statement of financial position at their fair value over the life of the derivative. For interest rate risk management, most often it is a cash flow hedge, where this is the hedge that fixes an otherwise variable cash flow that will affect the P&L. So this will be more module 7, hedge accounting type of stuff. So I wouldn't really go into this too much, but if it's effective hedge, then all fair value gains or losses are recognized in the other comprehensive income or equity account. And subsequently, this will be reclassified to the P&L in the same period or the periods during which the underlying transactions affects P&L. There's this term called bootstrapping. This is just like when you're lacing your bootstrap. This is to derive a curve with no interest payments from which any yield can be priced, whether spot or forward. So you would first calculate a single par or zero coupon price point, and then you would calculate a further par price and continue the process to gradually link all prices together to calculate a zero curve or zero coupon fixed income yield curve. For forward rates, the formula is discount factor at near date, divide that by discount factor at the far date. So the date that's closer, divide that by the date that's far away, minus 1 times 365 divided by the number of days between near and far dates. So for interest rates, the main things were the formulas, but I'll have to look through this in the test. That was interest rate risk management. Now we're gonna look at module 6, foreign exchange and commodity price risk management.